Welcome to Option Trades Today. I'm Tony the Bat Batista, and it is April 6th, 2023, and I've got a trade idea for you today, something you've been asking for some time, a calendar spread or a diagonal with implied volatility very low or relatively low over the last couple of weeks. That's the trade we're going to look at. But before we do, can you do me a favor? Can you open, move, bring your account to tastytrade.com. Help me keep the lights on here at Tasty Live, bringing you all of this great content that we do for free. The way to support us is by opening up an account at Tasty Trade. Let's take a look at what's going on in the market. Even the S&Ps right now are up $6 and change, but more than that, let's take a look at what volatility is doing. Volatility down another 17 cents today to 2025. Do you know that the 20-year average in /VX volatility is right around $20? So we have really come down from high implied volatility into this very low implied volatility range. So what am I looking at? Well, I'm going to look at a trade that has to have, something that didn't cooperate or go with the market. Let's take a look at the E-mini S&Ps for a moment. You can see how the E-mini S&Ps have had a nice run over the last week or so. The same thing with the NASDAQ. And you know, last week or on Tuesday, we went into the Russell that had been underperforming the market with a skewed strangle, which gave us a little bit of long delta in that. And even though the Russell over the last 2 days has not gone higher, volatility has contracted, and we've been able to make a little bit of money on that strangle that actually has long delta to it with the Russell going lower. I'm going to try to catch that same kind of lightning in a bottle here today with Costco. Got a lot of emails from Costco. I listen to everything that you guys send to me, and they're like, listen, Costco's a great company. It has not cooperated with the market, especially after this large $10 and change sell-off that was much bigger than that. Costco traded down to $4.77. It's $4.86 right now. So I'm not doing this bullish trade on the lows of the day at all. So maybe you might want to wait on it. I mean, I have to do my podcast when I do. You can do your trades whenever you want to do. And you can see the Costco implied volatility is just ever so slightly trying to tick up here a little bit, but the IV rank is still low at under 2%. So what am I going to look to do here? All right, I told you I have to do a diagonal spread. I want to look to lean a little bit long in Costco because it hasn't participated that much with the market. It does have a 0.64 correlation to the overall S&P market, so it's a relatively high, not in the 80s or 90s as you would see in some other products, but relatively high at 0.64. That correlation goes from a negative number, which would mean it would negatively correlated, to a positive number of 100, which would be impossible because that would be completely correlated with SPY. That's what it's judged with. So 0.65 at the higher end of that range. So what am I going to look to do? Well, I like to avoid earnings, but if I can use earnings to my advantage, then maybe there's a strategy there for me to do that. And what do I mean by that? Well, we all know that volatility or premium stays bid a few weeks before earnings. Now, you could say, well, then you should go into the May 26 options in Costco. And if you look at them, the markets are just a little bit too wide for me, 60, 70, 80 cents wide. So I can't do the May weekly options. So I'm going to look to do a June, May diagonal. Now, you could do a calendar spread, which would be neutral. I'm going to lean a little bit bullish. So what am I looking to do? I like to buy a couple of strikes in the money and sell a couple of strikes out of the money or just at the money when I'm looking at a diagonal spread. So what am I going to do here? I'm going to go into Costco and I'm going to put up something like I'm going to buy the June 70s, which are 3 strikes in the money, and I'm going to sell the April 485 calls that are right at the money. When I made this trade at $16.35, that's what I have up there for you right now, it was right at the money, just outside of the money. You can see that trade when you go to the follow page here on Tasty Trade, and you click on Bob the Trader, that's me, And when you click on Bob the Trader, you'll see Costco down here. I just did it a moment ago when Costco was trading at 485 and change. The IVR was actually a little bit higher at 3%, and you can see I got paid at $16.35. I write a little description on what I'm doing. It's a bullish diagonal spread. Let's go back to the trade if we can. Let's just take a look at it from a high level. Buying power effect is going to be whatever you pay for this diagonal. I paid $16.35. That's $1,635. It's got a beta weighted delta of 9 and an overall delta of 10, so very highly correlated to the S&P 500. Again, trying to catch a falling knife on a stock that usually participates with whatever the market is doing. Look at the theta decay. It has a positive theta decay. If you take a look at this trade, I'm selling about $16 and change in premium. And if you go to May, if you go to May, I'm selling about 16. This is the May with 43 days. I'm going to May. I'm selling about $16 in premium. And if you go to June 70s, I'm really only buying about $12 or $13 in premium. So I like to put on these trades where I'm at least premium positive, meaning I'm selling premium on the overall trade. So I have a little bit of help with that trade. Now, what's the probability of profit on this trade? Well, I don't know because we can't tell what volatility is going to do, and neither can the computer. But let's take a look at something on the setup. In May, you have a volatility of 24. In June, you got a volatility of 26.5. I don't want to put on trades that have more than a 2.5%. This is right at the upper end, more than a 2.5% differential between the two. But remember what I said in the beginning of this podcast. I'm thinking, or my assumption is, that May, with earnings coming on the 25th, is going to bring June volatility a little bit higher or keep it bid. And maybe after this move lower in Costco, this May volatility will continue to go lower, maybe drop down into this $21 range. Now, in May, you have about a $25 expected move over the next 43 days. So let's simulate for a quick moment what would happen if the stock were to go up or down, $15, $25. Let's go to the extreme so we can tell what our risk is. All right, this will be a little bit of a lesson on diagonal spreads. I think you'll find beneficial. So if you notice, between May and June, 43 days and 71 days, there's 28 days in between there. There's 28 days between May with 43 days to go and April with 15 days to go. Now, all things being equal, I would like to be out of this trade when May has 21 days left to expiration, not 15 days left to expiration. So we're a little bit, in my example, we're going to be a little bit late on the example. So let's just take a look at it. If things go horribly wrong, let's say the stock in the next 28 days or so goes all the way down to $25, which certainly could happen. You see, look what happened at Costco today. Anything can happen, right? So synthetically, I would be long the May 495 calls. Let's go into the May. Because all I'm saying is this is June. We fast forward by 28 days. My June options have 43 days to them. They no longer have 71 days to them. We're synthetically going ahead in time. So I'm going to buy the 495s. Those are what I'm synthetically long by being long the 470s. Because we've moved $25. So my calls that were in the money are now out of the money. I hope you're following on this, me on this. I'm just fast forwarding time and leaving volatility exactly where it is to see how much my risk is on this overall trade. So the May 495 calls that are simulating the June 470 calls 25 days in advance. The April options I'm going to sell are simulating the May 485 calls that I sold. But now, since it's $25 out, they're only the 5/10s. And look, they're only trading for 95 cents or a buck. So you can see that this trade is trading for around $10. If all things go wrong and Costco goes down twice as much as it's supposed to in the next 28 days or so, my spread that I'm long at $16 and change will be trading around $10 if volatility and everything stays exactly the same. Let's simulate the good scenario, okay? Let's simulate that you don't do anything to this trade and volatility doesn't move or expand like I'm hoping it will. Again, I'm going to go to the May options and simulate those June 470 calls that I'm long. Well, they would be in the money now, right? So I'm going to go to the 445 calls. Those would be that's simulating the June 470 calls that I'm long. All I'm doing is moving my strikes by $25, so I'm deeper in the money in May. And I'm going to, in April, sell the 460 calls. 460 calls. Those are simulating. $25, 485, yes, 460 calls, perfect. And that spread that I'm long at $16 and change is trading just about $18 or so. So you can see you have no risk to the upside. What's the best case scenario for this trade? Well, the best case scenario for this trade is Costco stays inside the range that it's supposed to have, $25. And volatility expands in June. Well, I hope you enjoyed this demonstration. I hope your risk is $1,600 or whatever you pay for it, $1,635. It looks like volatility has to expand for this trade to double its money. What would I be looking for as a net profit on this trade? I don't know, a buck or two, the same thing I'm looking for on a strangle. This is a defined risk trade. And if volatility expands, you'll be able to make a little bit more money on this trade. I hope you enjoyed this demonstration. I hope you enjoyed this trade, and I hope Costco goes a little bit higher because that's what I need for this trade to be profitable.